There's a global market worth more than $600 trillion, a market so massive that it dwarfs the world economy many times over. Yet almost nobody truly understands how it works. It nearly destroyed the global financial system in 2008, and today it's 10 times bigger. Warren Buffett once called derivatives financial weapons of mass destruction. He wasn't exaggerating. These instruments triggered the collapse of Lehman Brothers, the bailout of AIG, and the near death of the global banking system itself. But here's the part almost no one realizes. After the crisis, the world didn't eliminate derivatives. It didn't even reduce them, it expanded them. Governments, banks, hedge funds, even pension funds, continued piling into a system they knew could implode again. Why? Because the modern financial world is built on derivatives, and removing them would collapse everything from interest rates to mortgages to government debt. The crisis of 2008 wasn't a warning, it was a preview. To understand why derivatives hold so much power, you need to realize what they really are. They're not assets. They're bets, contracts whose value comes from something else, a house, a stock, a currency, a loan. And while the underlying asset might be worth billions, the derivatives built on top of it can be worth trillions. It's leverage on top of leverage, bets stacked on other bets, forming a global tower of risk that no regulator fully understands. In 2008, that tower started to fall. Lehman Brothers collapsed because it was sitting on a mountain of mortgage-backed securities and credit default swaps, derivatives tied to the U.S. housing market. When homeowners began defaulting, the entire web of interconnected bets unraveled. AIG, one of the world's largest insurers, had sold so many swaps guaranteeing mortgage bonds that it couldn't pay when the losses hit. The government had no choice but to bail it out. Without intervention, the entire banking system would have frozen overnight. But here's the uncomfortable truth. Nothing fundamental changed after 2008. Banks became safer on paper, but the derivative market kept expanding behind the scenes. Regulators forced some contracts onto clearinghouses, but those clearinghouses themselves became new single points of failure, giant institutions guaranteeing hundreds of trillions in trades. If even one clearinghouse fails, the shockwaves could be worse than 2008. Meanwhile, exotic new derivatives emerged. Volatility derivatives, synthetic credit derivatives, complex index swaps. Products so convoluted that even experienced traders sometimes can't fully explain them. They're profitable. They're opaque, and they're everywhere. The irony? The modern economy depends on them. Interest rates for homes and businesses rely on interest rate swaps. Government debt markets rely on futures and options. Corporations hedge everything, from fuel prices to currency exposure, using derivatives. Without them, global finance would seize overnight. So we live in a paradox. The system is too dangerous to keep, but too important to kill. And that means one thing: when the next crisis hits, it will be bigger, faster, and harder to control. Because the world didn't remove the risk, it multiplied it. And most people don't even know the game has already begun. To understand why the world allowed this system to grow, you have to follow the incentives. Derivatives are profit machines. Banks earn billions trading them, hedge funds use them to amplify returns, and corporations use them to shift risk. Everyone benefits until the day it unravels. This isn't accidental, it's structural. Derivatives create an illusion of stability, like dumping toxic waste in a deep ocean trench. You don't see it, but it's there, waiting for one shift to bring it all rushing back. And that shift is coming. The real danger isn't a single bank collapsing. It's what regulators call correlation risk. In a panic, everything moves in the same direction, and all the dominoes fall at once. The biggest domino today isn't a bank, it's the clearinghouses. After 2008, regulators forced trades through these centralized giants, hoping to make the system safer. Instead, they created the ultimate single point of failure. If one major clearinghouse fails, the shock won't hit a single bank. It will hit all of them instantly. Now combine that with a global economy drowning in debt. This is why regulators panic when interest rates move too quickly. The derivative system can't handle shocks. One unexpected spike, and the chain reaction begins. In 2008, the crisis unfolded over months. Today's system is different. It's automated. Instant to crisis that once took months can now ignite in hours. Central banks know this. They aren't controlling the economy. They're just trying to keep the derivative monster alive by flooding the system with liquidity. You'll hear the system is safer now, that stress tests prevent failures. But those tests assume normal conditions, not chaos. In a real crisis, every major bank is only as safe as the weakest link in the global chain. The truth is terrifying. The derivative market is now so large and complex that no government can control it. You can't shut it down without shutting the world down. So instead, they hope it never breaks. But hope is not a strategy. Financial systems built on leverage and blind confidence always collapse. The only question left is, what will trigger the next one? This is exactly what happened in the years before 2008. Everything looked stable, everything looked calm, everything looked profitable, until one bank, Lehman Brothers, failed to roll over its positions, and the entire global economy almost imploded in 36 hours. If the US government hadn't stepped in with trillions of dollars, the world would have entered a second Great Depression. And that was when the derivatives market was only about 600 trillion. Now, it's over $6 quadrillion in notional exposure when you include all layers: swaps, futures, options, forwards, synthetic credit, collateralized structures, and the shadow layers stacked on top of them. This isn't a market anymore. It's a ticking machine, held together by speed, hope, and faith that nothing will go catastrophically wrong. But something is going wrong. Because today, the risk is no longer concentrated in banks, like in 2008. Now it has migrated into pension funds, insurance companies, asset managers, and the deepest corners of the shadow banking system, where losses can spread silently, invisibly, and uncontrollably. You can regulate banks, but you cannot regulate the shadows. And that is where the derivatives monster now lives. The irony is that modern finance depends on these shadows to keep everything running. Every government bond auction, every interest rate adjustment, every corporate financing deal, every commodity shipment across the ocean, every mortgage, every credit card, every currency. Everything depends on derivatives now. We built an economy on invisible contracts that could unravel faster than anyone can react. And this leads us to the greatest risk of all. The system has become too big to understand and too fragile to fail. If a major counterparty collapses today, a large insurer, a European megabank, a sovereign entity, the contagion wouldn't spread like 2008. It would spread instantly through automated trading systems, algorithmic margin calls, and collateral chains stretched across continents. No politician could stop it. No central bank could react in time. No amount of money could plug the holes fast enough. Because this time, the world isn't dealing with one Lehman Brothers. It's dealing with hundreds of mini-Lehmans, all interconnected, all leveraged, all balancing on the same fragile structure. And the worst part? Nobody knows which one breaks first. Because when systems collapse, they never collapse from the center. They collapse from the edges. And right now, those edges are starting to crack. Look at commercial real estate. Office buildings around the world have emptied out, valuations have collapsed, and banks are sitting on trillions in loans tied to assets that may never recover. What most people don't know is that a massive portion of those loans are wrapped in interest rate derivatives. When rates rose at the fastest pace in 50 years, it didn't just hurt borrowers. It detonated hidden losses across thousands of derivative contracts that are now underwater. Look at sovereign debt. Countries like Italy, Japan, and even the United States rely on complex swaps to manage interest payments. When the yield curve flips, or when inflation spikes, these swaps can reverse direction, turning what was supposed to be risk management into a blowtorch pointed directly at national budgets. And look at the currency markets. In 2022, the Bank of England had to intervene because pension funds were about to collapse due to something called LDIs, liability-driven investments. It sounded harmless, safe, conservative. It wasn't. It was a highly leveraged derivative strategy that almost wiped out the retirement accounts of millions of British citizens in a matter of hours. All of these edges are flashing red at the same time, not because of one event, but because the entire system is wired in a way that amplifies instability instead of absorbing it. Derivatives were meant to spread risk. Instead, they concentrated it into a few pressure points that no one can see until they explode. And this is where the truly frightening part begins. Most people imagine a financial crisis as a big bank failing or a stock market crash. But the next crisis won't look like 2008. It won't start with subprime mortgages or reckless traders blowing up investment banks. It will start with a margin call, a sudden spike in collateral requirements, a single counterparty unable to post cash in time, a chain reaction racing through the global financial network at the speed of light. Because today, derivatives are settled by machines, algorithms, automated clearing systems, and collateral engines that do not think, do not negotiate, do not wait. If they detect risk, they trigger calls instantly. If collateral isn't paid, they close positions instantly. This is the part nobody is prepared for. Because while policymakers reassure the public that the system is sound, behind the scenes, they're running war games, simulations of what happens when a critical node defaults inside the derivatives network. And the results are terrifying. In these simulations, it's never the biggest bank that triggers the collapse. It's always a mid-sized institution, a pension fund, a clearinghouse, or a foreign bank that most Americans have never heard of. These smaller institutions are deeply embedded in derivative chains, often acting as counterparties to much larger players. When one of them fails, the shockwave doesn't spread linearly. It multiplies. Think of it like a fuse. Tiny, thin, inconsequential, until it reaches the explosive. A mid-sized bank in Europe misses a collateral payment. A clearinghouse questions the liquidity of its positions. A margin call is triggered. Automated algorithms liquidate billions. Markets move violently. Volatility spikes. Other institutions tied to the same contracts start taking losses. Collateral evaporates. More margin calls. More liquidations. The cascade becomes unstoppable. This isn't fiction. It isn't theory. This is exactly what almost happened in March 2020. A complete freeze in global dollar liquidity, triggered by highly levered derivative positions held by foreign institutions. Only a massive emergency intervention by the Federal Reserve prevented a total global meltdown. And that was just a warning shot. Since then, leverage has grown. Derivatives have multiplied, exposure has deepened. And the system has become even more dependent on the one thing it cannot guarantee: liquidity. Liquidity is the oxygen of modern finance. But in a derivatives-driven world, oxygen can disappear in seconds. All it takes is one failed payment, one missed rollover, one frozen market, one unexpected rate move, one geopolitical shock. Once that happens, liquidity vanishes, the gears stop turning, and the machine suffocates. The terrifying truth: the system is designed to fail fast. Because derivatives aren't slow-moving instruments. They reset daily, they settle daily. They demand collateral daily, and when volatility rises, they demand even more collateral, faster than humans can respond. This creates what experts call a self-reinforcing doom loop. Volatility rises, margin calls increase, institutions sell assets, selling increases volatility, even more margin calls, even more forced selling. It's the financial equivalent of a black hole. Once you cross the event horizon, escape becomes impossible. And right now, the global economy is inching dangerously close to that horizon. Governments know this. That's why every crisis in the last decade has been met with drastic measures. Trillions in emergency liquidity, unlimited swap lines, bond buying on a scale never seen before, zero or negative interest rates, direct market intervention, backstops for entire industries, bailouts disguised as stability operations. These aren't signs of strength. They're symptoms of a system on life support, a system that can no longer allow true market forces to operate, because if they ever did, really did, the derivative architecture beneath everything would collapse instantly. This is why so much of finance today feels artificial. Why markets rise even when economies weaken. Why asset prices seem disconnected from reality. Because reality is too dangerous. Reality would break the system. So we live in a global economy where the appearance of stability matters more than stability itself, where policymakers are forced to maintain an illusion, not to deceive the public, but to prevent panic from igniting the fuse. But illusions don't last forever. A system this fragile can absorb shock after shock after shock until suddenly it can't. The next crisis won't look like 2008. It will be faster, more chaotic, more unpredictable, and far more global. Because now the entire world is tied together by invisible contracts. Trillions upon trillions of obligations that reset every minute, every hour, every day. We built a financial civilization on top of a bed of sand. And the tide is starting to come in. And here is where the story reaches the point most analysts are too afraid to discuss publicly. What actually happens when the system finally breaks? Not theoretically, not academically. But in the real world, the answer is brutal. Because once the derivative machine begins to unwind, the consequences move far beyond banks and hedge funds. They seep into everything: savings, jobs, currencies, governments, and the basic functioning of the global economy. The first thing that happens is the collapse of liquidity. Money stops moving, banks stop lending, corporations freeze hiring, markets gap violently. Interest rates swing in ways they were never meant to. It's not that banks don't want to lend. They simply can't. When derivatives blow up, institutions hoard cash like oxygen during a fire. They don't trust counterparties because nobody knows who's solvent. Nobody knows who's exposed. Nobody knows who will be forced to liquidate next. This breakdown of trust is deadly. It turns healthy businesses into bankrupt ones overnight. It turns small market tremors into system-wide earthquakes. It turns liquidity, the most basic ingredient of modern finance, into a rarity. The second thing that happens is forced asset sales. Funds have to liquidate positions to meet margin calls. Banks dump bonds to raise cash. Corporations sell whatever they can to keep their balance sheets alive. Governments face surging borrowing costs as investors race for safety. But here's the catch. When everyone sells at the same time, there is no one left to buy. Prices collapse, volatility explodes, the feedback loop accelerates. This is exactly what systemic collapse looks like. Not a slow decline, but an avalanche triggered by a single shift in weight. The third consequence is currency distortion and capital flight. When derivatives tied to interest rates and foreign exchange blow up, currencies behave erratically. The dollar spikes, emerging markets collapse. Countries with high debt ratios, Argentina, Turkey, Egypt, Pakistan, spiral into crisis almost instantly. But the shock doesn't stay there. It spreads inward. Japan faces massive losses on interest rate swaps. Europe faces existential pressure on its sovereign bond markets. The United States faces exploding deficits as borrow costs surge. Derivatives turn local problems into global ones, and global problems into uncontrollable ones. And then comes the fourth stage, the most dangerous, political panic. Because when markets break, governments step in, not with small measures, with extreme, unprecedented actions, freezing markets, halting trading, nationalizing failing institutions, imposing capital controls, printing trillions in emergency liquidity, coordinating international bailouts, rewriting debt obligations on the fly, pushing new regulations overnight. And when governments panic, citizens panic too. They rush to withdraw money from banks, buy hard assets, or flee collapsing currencies. This creates a second wave of instability, a social panic layered on top of a financial one. But here's the final twist. The part almost nobody understands. The next crisis will not be allowed to fully unfold. Governments won't allow another Lehman. Central banks won't allow the system to unwind. Regulators won't let failure happen naturally. Because if they do, the derivatives machine collapses entirely, and with it, the modern financial world. So instead of allowing a real correction, the response will be something far more radical. The largest bailout in human history. A backstop not for banks or insurers or hedge funds, but for the entire derivatives ecosystem itself. This is not speculation. This is already being discussed behind closed doors. Central banks understand that the next crisis won't be a market event. It will be a plumbing failure, a total seizure of the system's hidden machinery. The only way to prevent collapse would be to step in as the ultimate counterparty to everything. Interest rate swaps, currency swaps, credit derivatives, commodity futures, equity options, synthetic exposures, and every other leveraged contract choking the system. In other words, the government becomes the market. A complete takeover, a financial nationalization, a global emergency stabilization effort on a scale billions of people cannot imagine. And once that happens, the world enters a new era, one defined not by free markets but by centralized control. An era where financial risk is absorbed by public balance sheets. An era where failure is impossible, but so is true prosperity. A world where the price of stability is freedom. This is the endgame. This is what lies at the end of a $6 quadrillion labyrinth. A system too large to fail, too complex to regulate, and too fragile to survive a true shock. A system that has already crossed the threshold where mathematics, risk models, and human judgment no longer apply. A system running on borrowed time. But the most unsettling truth of all is this. The collapse has already begun, quietly, invisibly, behind the numbers. Because systems don't announce their failures, they erode from within. They weaken long before anyone notices. They give off early tremors before the earthquake hits. And if you know where to look, those tremors are everywhere. You see it in the unprecedented volatility of global bond markets. Movements so violent they were statistically impossible under the old models. You see it in the liquidity air pockets, where prices suddenly jump with no explanation. You see it when the world's largest central banks buy trillions in assets simply to keep markets functioning. You see it in the desperation, the emergency rate cuts, the unplanned interventions, the sudden policy pivots, the way politicians speak in carefully controlled, overly sanitized language, as if a single wrong word could trigger a panic, because it could. The truth is, confidence is the last pillar holding the entire financial world together. Not collateral, not regulation, not capital buffers, confidence. A belief shared by billions of people that the system works, that money is safe, that debts will be honored, that the machine will keep running. But confidence is fragile. A whisper can shatter it. A headline can fracture it. A single institutional failure can destroy it. Once confidence breaks, the machine dies. And that's the moment leaders fear most. Not the mechanical failure itself, but the psychological chain reaction it unleashes. They know that if people ever discover how fragile the system truly is, they will no longer trust it. And without trust, modern finance cannot exist. This is why governments hide losses, why banks mask exposures, why regulators avoid honest conversations about derivatives, why crises are always rewritten as isolated accidents instead of structural failures, because the truth is too dangerous. The system isn't stable, it's balanced, precariously, like a glass tower built higher and higher, with each new derivative contract adding another floor, another beam, another layer of invisible complexity. The architects know it can't stand forever, but they hope it stands long enough. That hope is the core of global finance today. Not stability, not strength, but delay. Delay the margin call, delay the default, delay the recession, delay the recognition of losses, delay the collapse for one more month, one more quarter, one more election cycle. A system that depends on delay is already dying. It just hasn't hit the ground yet. And when it does, the fall will be unlike anything the world has ever seen. Because this isn't just another asset bubble. This isn't just another banking crisis. This isn't just another recession that governments can print their way out of. This is the failure of the underlying architecture. A collapse not of markets, but of the mechanisms that make markets possible. A failure of the machinery that silently keeps the world turning. And once the machinery stops, everything stops. Global trade seizes, corporations implode. Currencies fracture, governments scramble. And everyday citizens, the people who never even heard the word derivative, pay the highest price. Because while institutions can be bailed out, people cannot. Your savings won't be rescued. Your job won't be saved. Your currency won't be protected. Your future won't be insured. This is the true danger of derivatives. Not just their size, but their ability to turn private risk into public disaster. To transform silent failures into global catastrophes. To convert financial engineering into a weapon aimed at the stability of entire nations. And yet, despite everything, the world continues forward as if nothing is wrong. Markets rise, politicians smile. Central banks assure everyone that conditions remain strong. The media focuses on distractions, while the real threat grows beneath the surface. A threat no one can control, no one can stop, no one can unwind. Because this time, the system has backed itself into a corner. There is no clean exit, no safe unwind, no painless fix. There is only one path left, a reckoning. Not tomorrow, not years from now. But the moment the smallest crack reaches the deepest layer, the layer where trillions in unregulated, interconnected, leveraged contracts hold the world together by threads thinner than air. When that moment comes, the world will look back at 2008 as a mild warning, a distant tremor before the real quake. And the question, the only question that matters, is this. When the machine finally stops, who will be prepared? But preparation is not about predicting the exact moment of impact. It's about understanding the forces that make the impact inevitable. Because the system we live in today is not simply unstable, it is mathematically guaranteed to break. You cannot build infinite leverage on finite collateral. You cannot create risk faster than you create real capital. You cannot link global institutions through quadrillions in contracts and expect every one of them to remain solvent, liquid, and functional forever. Yet that is exactly the world we've created. A world where stability depends on perfection. Where one mispriced contract can threaten an entire region. Where a small hedge fund in Asia, a mid-tier bank in Germany, or a pension fund in Canada could, through the invisible threads of derivatives, trigger a global shock. This is the uncomfortable reality. The next crisis won't start where you're looking. It won't begin in Wall Street. It won't begin in Washington. It won't begin in the institutions everyone watches. It will begin in the dark corners, the unregulated zones where exotic instruments are traded far from public view. It will begin with a name nobody knows, a fund nobody tracks, a counterparty nobody notices until it's too late. And by the time the world realizes what's happening, the chain reaction will already be unstoppable. Because derivatives are not like traditional financial products. They don't fail gradually, they fail instantly. In a matter of seconds, liquidity disappears. In a matter of minutes, losses multiply. In a matter of hours, global markets convulse in synchronized chaos. This is the nature of interconnected systems. The stronger the connections, the faster the failure spreads. We've spent decades tightening the web, layering it with leverage, complexity, and automation, believing that technology always increases stability. But technology doesn't care about human optimism. It amplifies whatever system it touches. If the system is healthy, it accelerates growth. If the system is fragile, it accelerates collapse. And right now, the global financial system is the most fragile it has been in modern history. Debt is at all-time highs. Leverage is at all-time highs. Derivatives exposure is at all-time highs. Central banks are out of ammunition. Governments are drowning in deficits. Consumers are stretched beyond capacity. This is not a slow-building crisis. This is an unstable equilibrium, a balancing act so delicate that even the smallest tremor can shatter it. And those tremors are multiplying. Rising interest rates, rapid deglobalization, political polarization, currency volatility, energy instability, geopolitical conflict, shrinking liquidity, central banks reversing decades of easy money. All of these forces push against the same weak points. The derivatives embedded at the core of the financial machine. This is why the smallest shocks now feel disproportionate. Why minor events trigger major reactions. Why markets swing violently on news that once would have barely moved them. The system is so tightly wound, so heavily leveraged, that tension has replaced resilience. And when tension replaces resilience, collapse is just a question of timing. But here's the part that most people miss. When the system finally breaks, it won't be the collapse itself that changes the world. It will be what comes after. Because crises don't just destroy. They reshape, they redefine. They create new rules, new powers, new structures. And in the aftermath of a derivatives-driven crisis, the world will not return to the system we know. It can't. The old architecture will be permanently broken. The trust that underpins it shattered. The illusions that supported it exposed. What will rise in its place will be something more controlled, more centralized, more tightly monitored. A world where governments play a far larger role in markets. A world where financial freedom shrinks in the name of stability. A world where digital currencies and programmable assets replace cash and traditional banking. A world rebuilt not on open markets, but on enforced stability. This is the long-term consequence. The real endgame, hiding beneath the layers of leverage and complexity. Because when the machine fails, the people who rebuild it won't design a freer system. They'll design a safer one. And safety always comes with a price. We are not heading toward the next chapter of the old financial system. We are heading toward the birth of a new one. A system forged in crisis. A system defined by centralization. A system where the mistakes of the past are replaced by the controls of the future. And the only question that remains, the one the world has avoided for far too long, is this. Will we recognize the transition before it happens, or only after the old world has already vanished? But this time, the consequences would be very different, Because unlike 2008, the world is no longer dealing with a banking system that can be rescued by throwing trillions of dollars at the problem. Today's financial landscape is far more interconnected, far more leveraged, and far more dependent on derivatives than ever before. A single shock doesn't just hit one institution. It ripples across the entire global economy in seconds. And here's the part almost nobody talks about. Most of the derivatives in the world aren't traded on public exchanges. They're private contracts, invisible, unregulated, hidden. Banks call them customized instruments to make them sound sophisticated. In reality, they're IOUs stacked on top of IOUs, layered into structures so complex that even the people who sell them barely understand what they're holding. These contracts connect every major bank, hedge fund, insurer, and corporation in a web so dense that if one major player fails, the entire system could freeze instantly. Think back to 2008. AIG didn't collapse because it held bad mortgages. It collapsed because it sold trillions of dollars in credit default swaps, insurance on debt, and didn't have the money to pay when those debts soured. When Lehman Brothers went down, AIG owed everyone. If AIG fell, every major bank in the world would fall with it. That's why the government stepped in, not to save AIG, but to save the entire global system. Now imagine that same scenario today, except multiplied. Because the uncomfortable truth is this: derivatives didn't disappear after 2008. They exploded, banks learned nothing. Regulators changed nothing, and investors demanded even more leverage, even more yield, even more ways to gamble with money they didn't actually have. Today's financial system is like a skyscraper built out of glass. Breathtaking, enormous, and fragile enough that one crack at the foundation could bring the whole structure down. The most dangerous part? Nobody knows where the crack will appear. It could be in commercial real estate, which is already collapsing in major cities as office buildings sit empty. It could be in sovereign debt, as countries borrow at historic levels with no plan to ever repay. It could be in currency markets, where nations quietly prepare for de-dollarization. Or it could be in something far smaller, a bank you've never heard of, a hedge fund operating out of Singapore, a trading firm in London, a pension fund in Canada. Because that's how systemic crises happen. Not with a headline, not with a warning, but with a small failure that triggers a chain reaction, one that spreads faster than governments can respond. And here's the twist. The same institutions that nearly blew up the world in 2008 are bigger today than they were then. Bigger banks, bigger leverage, bigger risks, and derivatives, the exact instruments that triggered the crisis, are now at record highs. There's something else they aren't telling you. Many of these derivative contracts are tied to interest rates. And over the last 2 years, interest rates have risen at the fastest pace in modern history. That means the value of trillions in contracts has shifted violently, creating massive gains for some and catastrophic losses for others. But you won't see those losses on a balance sheet. You won't see them in quarterly earnings. You won't see them in the news. They're hidden, deferred, rolled over, repackaged, buried in accounting tricks that disguise risk as stability. It's the same movie, the same script, the same everything is fine attitude that came right before the last collapse. But this time, the stakes are higher. Because in 2008, governments still had tools to stop the crisis. Today, interest rates are already high. Debts are already massive. Money printing has already been pushed to its limit. The safety net is gone. So the question isn't if something breaks. The question is when and who gets hit first. And when the next shock finally hits, you won't hear the warning on the news. You won't get an alert from your bank. There won't be a countdown or a siren. It will happen in silence. A quiet failure, a missed payment, a liquidity freeze, a derivative position that moves 1% too far. And in that moment, the $600 trillion shadow market that almost nobody understands will suddenly become the only thing that matters. Because when derivatives blow up, everything blows up. But here's where the story becomes even stranger. Because while most people think the 2008 crisis was fixed, the truth is that the system didn't just survive, it mutated. Banks didn't slow down derivatives. They industrialized them. They automated them. They pushed them deeper into the financial plumbing where no regulator, no journalist, and definitely no ordinary citizen could ever see them. Today, the derivatives market isn't just bigger. It's more leveraged, more interconnected, and more fragile than at any point in human history. And here's the part nobody wants to admit. The world's financial system is now so dependent on derivatives that it cannot function without them. If they disappeared overnight, global trade would stop. Commodity markets would freeze, bond markets would collapse. Banks would fail instantly. Derivatives were supposed to manage risk. Instead, they became the source of it. They act like financial dark matter, unseen, unregulated, but holding the entire system together with forces nobody fully understands. And this is where the danger truly lies. Because when nobody fully understands a market this big, no one knows what will happen when it breaks. And it will break. Not because of some Hollywood-style financial villain, but because the system itself has evolved into something fundamentally unstable. Think of it like stacking sticks in a pile. Each stick alone is harmless, but stack enough of them, tightly, with enough tension, and the whole structure becomes so sensitive that a single straw can bring everything down. Derivatives have become that straw. The system is so complex that even the people running it admit they've lost control. In 2013, the head of the U.S. Federal Reserve, Ben Bernanke, publicly stated that the derivatives ecosystem had grown beyond the capacity of any regulator to observe in real time. In other words, the firefighters don't know where the fires are, or when they will ignite. Banks know this, governments know this, the IMF definitely knows this, and so, instead of trying to reduce the derivatives market, they've adopted a new strategy. Pretend it's safe as long as nothing bad happens. But preparation is not about predicting the exact moment of impact. It's about understanding the forces that make the impact inevitable, because the system we live in today is not simply unstable, it is mathematically guaranteed to break. You cannot build infinite leverage on finite collateral. You cannot create risk faster than you create real capital. You cannot link global institutions through quadrillions in contracts and expect every one of them to remain solvent, liquid, and functional forever. Yet that is exactly the world we've created. A world where stability depends on perfection, where one mispriced contract can threaten an entire region, where a small hedge fund in Asia, a mid-tier bank in Germany, or a pension fund in Canada could, through the invisible threads of derivatives, trigger a global shock. This is the uncomfortable reality. The next crisis won't start where you're looking. It won't begin in Wall Street. It won't begin in Washington. It won't begin in the institutions everyone watches. It will begin in the dark corners, the unregulated zones where exotic instruments are traded far from public view. It will begin with a name nobody knows, a fund nobody tracks, a counterparty nobody notices until it's too late. And by the time the world realizes what's happening, the chain reaction will already be unstoppable. Because derivatives are not like traditional financial products. They don't fail gradually, they fail instantly. In a matter of seconds, liquidity disappears. In a matter of minutes, losses multiply. In a matter of hours, global markets convulse in synchronized chaos. This is the nature of interconnected systems. The stronger the connections, the faster the failure spreads. We've spent decades tightening the web, layering it with leverage, complexity, and automation, believing that technology always increases stability. But technology doesn't care about human optimism. It amplifies whatever system it touches. If the system is healthy, it accelerates growth. If the system is fragile, it accelerates collapse. And right now, the global financial system is the most fragile it has been in modern history. Debt is at all-time highs. Leverage is at all-time highs. Derivatives exposure is at all-time highs. Central banks are out of ammunition. Governments are drowning in deficits. Consumers are stretched beyond capacity. This is not a slow-building crisis. This is an unstable equilibrium, a balancing act so delicate that even the smallest tremor can shatter it. And those tremors are multiplying. Rising interest rates, rapid deglobalization, political polarization, currency volatility, energy instability, geopolitical conflict, shrinking liquidity, central banks reversing decades of easy money. All of these forces push against the same weak points, the derivatives embedded at the core of the financial machine. This is why the smallest shocks now feel disproportionate, why minor events trigger major reactions, why markets swing violently on news that once would have barely moved them. The system is so tightly wound, so heavily leveraged, that tension has replaced resilience. And when tension replaces resilience, collapse is just a question of timing. But here's the part that most people miss. When the system finally breaks, it won't be the collapse itself that changes the world. It will be what comes after. Because crises don't just destroy. They reshape, they redefine. They create new rules, new powers, new structures. And in the aftermath of a derivatives-driven crisis, the world will not return to the system we know. It can't. The old architecture will be permanently broken. The trust that underpins it shattered. The illusions that supported it exposed. What will rise in its place will be something more controlled, more centralized, more tightly monitored. A world where governments play a far larger role in markets. A world where financial freedom shrinks in the name of stability. A world where digital currencies and programmable assets replace cash and traditional banking. A world rebuilt not on open markets, but on enforced stability. This is the long-term consequence. The real endgame hiding beneath the layers of leverage and complexity. Because when the machine fails, the people who rebuild it won't design a freer system. They'll design a safer one, and safety always comes with a price. We are not heading toward the next chapter of the old financial system. We are heading toward the birth of a new one. A system forged in crisis. A system defined by centralization. A system where the mistakes of the past are replaced by the controls of the future. And the only question that remains, the one the world has avoided for far too long, what is this? Will we recognize the transition before it happens, or only after the old world has already vanished? And the terrifying part is this. The next crisis might not look anything like 2008. Back then, the problem was mortgages, a single market that was easy to identify. Today, the risk is everywhere. It's woven into commodities, currencies, interest rates, energy markets, corporate debt, government bonds, and even the plumbing of the financial system itself. This time, the trigger might come from a place the public least expects. Take interest rate swaps, for example, one of the largest derivative markets in the world. Governments, banks, and corporations use them to bet on or hedge against future interest rate moves. But when rates shot up faster than anyone predicted, these swaps moved violently out of balance. That means losses, massive, unreported, system-threatening losses, are sitting on someone's books right now. Who holds the losing side? Nobody knows. Who can't pay? Nobody knows. Who's already insolvent but pretending to be liquid? Nobody knows. That's the point. In a world built on derivatives, the danger is invisible until it's too late. And when the truth finally emerges, it usually emerges all at once. Look at the UK pension crisis in 2022. Almost nobody noticed it until the entire system was hours away from collapse. Pension funds had used derivative-based strategies called LDI, leverage on top of leverage, to amplify returns in a low-rate environment. When bond yields spiked unexpectedly, margin calls wiped them out instantly. The Bank of England had to intervene with a surprise emergency bond purchase program to prevent a nationwide collapse. That was just a small taste of what can happen when derivatives unwind. Now zoom out. Imagine that same scenario, but not just in one country. Imagine it hitting multiple markets simultaneously. Imagine liquidity disappearing faster than central banks can react. Imagine 2, 3, or 10 institutions failing within minutes of each other, all connected through opaque derivative contracts. That's how contagion works. That's how systemic collapse spreads. And that's what nobody is prepared for. Because here's the truth the financial elite will never admit publicly. The global financial system is no longer built on money. It's built on leverage. Every dollar is stretched into 5. Every asset is rehypothecated. Every risk is transferred, sliced, repackaged, and sold again. It's a house of mirrors, where nothing is what it seems. The banks claim it's safe because they've modeled the risks. But the same banks said the same thing in 2008. They said housing never falls nationwide. They said AOA-rated derivatives were bulletproof. They said their risk models accounted for everything. And they were wrong. They're even more wrong now. Because today's models assume something insane, that interest rates, currencies, commodities, and markets can all swing wildly. And somehow, no major institution will be overwhelmed. But the models don't account for one key variable, human panic. When people lose trust, markets freeze. When markets freeze, liquidity vanishes. And when liquidity vanishes, derivatives become time bombs. Suddenly, every contract needs collateral. Every margin call comes at once. Every institution scrambles for cash. And those with the weakest hands break first. Then comes the cascade. One failure triggers another. Another triggers 5 more. 5 become 50. And by the time the world realizes what's happening, it's already far too late to stop. The irony is brutal. A market created to manage risk has become the greatest source of risk in human history. And in a crisis of this scale, there's no bailout big enough, no central bank printing fast enough, no government agile enough. Because derivatives aren't just numbers. They're promises. And when the world loses faith in those promises, the entire system resets. But when it falls all at once. And when the system finally buckles under its own weight, the consequences don't remain confined to banks and trading floors. They spill outward into economies, governments, companies, homes, and everyday life. Because a derivative collapse is not just a financial event. It is a structural event. It rewires the world itself. The first sign is credit. Banks tighten lending instantly. Mortgages freeze. Corporate credit lines vanish. Small businesses lose access to working capital. Even large corporations, the supposedly untouchable giants, find themselves unable to refinance debt coming due. Layoffs begin quietly, then spread rapidly. Wages stagnate, investment halts. Then comes the second wave, government stress. Countries dependent on foreign capital see their currencies weaken. Import costs surge, inflation rises. Bond markets punish any nation deemed fragile. Some governments face downgrades, others face outright liquidity crises. Emergency measures are enacted, capital controls, temporary bank holidays, debt restructuring, forced mergers. But even these are just the early symptoms. Because the third wave is geopolitical. Nations blame each other, trading blocs fracture, alliances weaken, tensions sharpen. Countries with strong balance sheets begin hoarding resources. Countries with weak balance sheets start negotiating from positions of desperation. Economic power shifts, political influence shifts, entire global supply chains reconfigure. A derivative crisis does not just break markets. It rearranges global order. And ironically, the only stabilizing force becomes the same institution that unintentionally helped create the problem. The central bank. In the depths of the chaos, central banks coordinate the largest rescue operations in history. They deploy unlimited liquidity. They nationalize toxic assets. They merge failing banks, guarantee deposits, and purchase enormous quantities of distressed securities. They stabilize what they can, isolate what they can't, and slowly rebuild the pipes of global finance. But even they know the truth. They are not saving the system. They are replacing it. Because once the smoke clears, leaders realize something undeniable. The old architecture cannot return. A system that nearly imploded the entire world cannot be allowed to exist in the same fragile, opaque, interconnected form. And so the great redesign begins. Rules are rewritten, derivatives are reclassified. Clearing becomes centralized, leverage is restricted. Transparency becomes mandatory. Banks are forced to restructure. Governments move toward digital oversight. Some nations accelerate the creation of digital currencies to track systemic flows in real time. The world emerges more controlled, more monitored, more rigid, but also more stable. The chaos forces evolution. And this is the part nobody expects. In hindsight, historians conclude that the derivative collapse wasn't a financial accident. It was a correction, a reset, a forced evolution of a system that had become too large, too complex, and too dependent on mathematical illusions of safety. Civilizations don't fall because of chaos. They fall because they refuse to evolve. And sometimes, only crisis can trigger the evolution necessary to survive the next century. When future generations study this era, they won't remember the daily market swings or the political arguments or the headlines filled with fear. They will remember one thing. This was the moment the world finally understood the cost of building prosperity on leverage instead of value. And in that realization, something new begins. Not a collapse, not an ending, but a transformation. The painful, necessary transformation of a global financial system stepping into its next form. A world that can no longer pretend risk doesn't exist. A world that can no longer depend on hidden contracts to hold everything together. A world forced to rebuild its foundation, not on derivatives, but on transparency, resilience, and truth. Because in the end, stability is never the absence of danger. It is the ability to withstand it. And this time, after the dust settles, the world finally learns that lesson.